why is it that when we buy cars and we buy assets like phones and computers, they lose value over time? Why is it that the value of my asset that I bought, all right, well, some assets, not all of them, but why is it that it is losing value? And it's this little thing called depreciation. And depreciation, by definition, is a reduction in the value of an asset over time due to wear and tear, all right? And that kind of sucks, right? Because an asset that I bought, all right, I bought it for this amount of money, my hard-earned money, right? And now it's losing value over time. So we're going to be talking about that, okay? And there are three different methods to depreciation, and these methods are only an estimation, all right? In the real world, we can just use this as kind of a model, as an estimation, as I said, all right? So the first method is the easiest, and it's called the straight line, okay, the straight line method, all right? The second one is known as the diminishing value method. And then the third one, which is maybe the least common one, is the units of production method. All right. And now, depreciation, if you haven't heard about it before, it could be a hard thing to grasp, but I understand that I explain it one way, and not everyone can understand it the way I explain it. So, if you have any questions or anything like that, you just drop it down in the comments below, and I'll try my best to get to it, right? Because all I want to do is help you understand these topics. All right, so the first method, all right, the straight line method, all right, this here is a linear way of looking at depreciation, right? So if I were to draw it as a graph, all right, just like this, and I had my y and my x, all right, this here would be the dep amount, all right? I'm just going to abbreviate. It would be the dep amount, and the x would be the amount of time, all right? So as you can see, over time, depreciation stays constant. And for each of these methods, we're going to be looking at an example and defining them just like this, all right? So the straight line has a formula, all right? And I'm just going to say STM as abbreviation for straight line method. And it is the purchase price, all right? The purchase price minus the salvage value, all right, divided by the estimated useful lifespan, all right, lifespan, all right. So we're going to look at an example of a Volvo C40. It's one of the new ones coming out, one of those electric ones. I love Volvo. I think they're glorious. I think they're graceful and beautiful and everything, all right, everything that's great about them. So let's say the C40, and let's say it will cost about $60,000. And Volvo says to me that, well, it will have a 20-year lifespan. All right, it will have a 20-year lifespan. And they also tell me that the salvage value after those 20 years, the salvage value after those 20 years is equal to about $2,000, meaning that after 20 years and like 200,000 miles or something, I can still get $2,000 for it. That is the minimum salvage value. It's also known as the residual value. And that is how then I can work out my depreciation using the formula. So I can say the depreciation I will get every single year would equal to 60,000 minus the salvage value being 2,000 divided by the 20 years of lifespan. And I will get the depreciation expense every year. All right. How cool is that? I think that's such a cool way of, estimating how much depreciation you'll be charged. All right. And saying, okay, after 1 year, how much value am I going to lose? All right. But now, it is different for every car, and this is only an estimation, and straight line is very simple and isn't really used for things like cars. It's the simplest estimation you can do. All right, but then we can look at the second way of looking at depreciation. All right, and this method is known as the diminishing value method. All right, as I've stated. All right, and this one looks at more things like computers. All right, so this one's computers. All right, and phones. All right, so this one's a good estimation for that sort of thing. But different companies depreciate in different methods, right? An iPhone will depreciate slower than a Samsung because iPhones hold their value for lower. And now you might be like, well, how is that accounted for? Now, the diminishing value method, all right, the formula for this one is actually quite similar. All right, it is the current book value, all right, times by the depreciation rate, which I know is even simpler, right? But the thing is, it's called the diminishing value, all right, meaning that the value of this asset, all right, is going to keep decreasing. And we're going to look at that. So if we had an iPhone, all right, and let's say it was an iPhone 13 and it costs about $1,000, all right, cool. How much then? All right, how much is then going to be the depreciation? All right, well, let's say the depreciation rate was about 10%, all right, 10% per annum. All right, that there is equal to the depreciation rate. Then after the first year, the depreciation expense is equal to this. It is equal to this 1,000 times by 0.1, which we all know is going to be about 100, right? 100, not 1,000, $100 in the first year. So how much is that phone going to be worth? Well, it's going to be worth $900, right? That's perfect. So we started off over here with $1,000, and then after year one, we had $100. And you might be saying, well, where's the salvage value for this one? Well, you see, the salvage value is actually used in the depreciation rate in working out, but we're not going to look at that today, all right? That is a bit more complex accounting, and it's rarely asked in any kind of exam. All right, but then how will we do it after the second year? And this is the main part about the diminishing value method. Remember, I said it's a diminishing value method, and it's equal to now 1,000 minus 100. You see, because I said it is the current book value, and the current book value after the second year is equal to $900. So you are minusing the accumulated depreciation. And again, we times by the same depreciation rate. So how much is the depreciation for this year? It's going to be $90. And the next year, it's going to be $80. No, sorry, it's not going to be $80. Don't listen to me on that one. All right, so how much is this going to be worth at the end of the second year? And it's going to be worth $900 minus $90, which is equal to about $810. And then you would work depreciation out on that one. All right, perfect. Now we can look at the next method, which is the units of production method. All right, I'm going to write it out once again in my slow handwriting. Units of production. All right, perfect. And this one is mainly used for like equipment. All right, equipment that they say can produce a certain number of things. So let's go back to the iPhone, and let's say Apple wants to buy this piece of equipment. All right, the iPhone maker. All right, the iPhone maker. Right now, the iPhone maker, what is it that it costs? All right, let's say it costs about $100,000. Right, I think $100,000 is maybe reasonable. And then let's say, all right, but it's units of production. So how many iPhones can it make? How many iPhones can it make? can it make in total over its lifespan? How many iPhones can it make? And we say that it can make about 1 million iPhones in total. All right. And then let's say, that it has a salvage value. All right. And let's say the salvage value of it is about $5,000. All right. $5,000, which is a bit low, but let's just say that. All right. So, and then let's say that every year it can produce 40,000. So every year it produces, all right, this machine produces about 40,000 units. All right. But in total, it can produce, 1 million. All right. So how would then this work? How would we calculate the depreciation expense? You see, the depreciation expense here is again, all right, we're looking at this, all right? It is the original cost. I'm just going to write it down. It's the original cost minus the salvage, all right? And this is similar to the straight line method divided by the production capacity, meaning how many can it make in total over its lifespan. All right, capacity, all right, times that then by the units per year. And the reason we're doing that is because we want to get the depreciation expense for every year. And so we can say, okay, it's going to be 100,000, okay, 100,000 minus the salvage, which we said was about 5,000. All right, cool. Divided by the production capacity, which we said was 1 million iPhones. All right, cool. That there times by the units per year, 40,000. So now we're just inputting these numbers. And then we get $3,800. And that there is our final answer. And that there is depreciation. A very simple look at depreciation in accounting at school. All right, I hope you enjoyed it. I hope you understood it. If you have any questions, just leave it in the comments below. I'd gladly help you. Have a great day. Stay happy. Stay healthy.